Welcome back to another episode. Today, I want to take a closer look at ARM Holdings. The company recently reported earnings, and the stock is all over the place, right? 52-week high of 164, 52-week low of $46.50. And right now, the stock is trading at $103. So, if we take a closer look at the overall forward PE ratios, this is a stock that currently is sitting forward PE of 69.5 and forward 1 year, which is the next 24 months, of 53. So in the past, I've definitely said that I've considered ARM Holdings a bit overvalued, actually a lot overvalued. But maybe after listening and reading through this earnings, my thought process or my opinion of that might have changed a little bit. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
So just a quick price action. We can see right now stock sitting at $103. Year to date, the stock is up over 50%, but like we saw, it is down from its 52-week high a nice amount. After earnings, the company did take a dip, but investors seem to have bought that dip a bit, and we can see the stock is kind of trading near of where it was before it reported earnings. So if we take a closer look, ARM, like I mentioned, forward PE ratio is sitting at 69.5. Those are for the next 12 months. Forward is the end of this fiscal year, and the company just started quarter one. Now forward 1 year is the end of next fiscal year, and that's expected to be 24 months from now, so 53. So we can see definitely, if you look at these numbers, the stock looks a bit overvalued. Now I have this cool presentation that I got from their overall transcript, and we're going to look at things like PC growth and some other growth opportunities for ARM. And then a closer reason of why I believe my opinion has changed on this valuation. But first, PC growth. The overall CEO of ARM believes that there's still a nice amount of growth here in the PC market, especially when we think about Windows, right? Because that's pretty much where they can only grow right now. Right now, the Apple ecosystem has already completely converted over to ARM chips. And obviously there's still growth in Apple because Apple can get market share compared to the overall PC market. But the biggest growth opportunity for them is the Windows. And they think that over the next number of years, they are positive about the growth potential here. And this is something that we are seeing pretty strong right now already. We are hearing a lot of competition here entering in the x86, like we just have Qualcomm release their Snapdragon X Elite, which is supposed to be a high-tier PC CPU for the Windows ecosystem. And we've also seen that a lot of these companies have started to create, like Google, like Microsoft, and all these other cloud service providers have started to create their own CPU for the server side using ARM chips. There is also a positive way, kind of hypothesis, or I wouldn't say it's blindfold thinking to think that these big tech players like Windows can start to create CPUs for the processor side and very kind of similar follow the Apple way and start to kind of get rid of themselves of x86 solutions. So there's definitely a nice growth opportunity here for the PC space, also especially with the AI market right now. All these companies need to continue to innovate as we are getting into this AI PCs.
Before we go any further, we are now on the road to 50,000 subscribers by the end of the year. Thank you all for the crazy support. So if you haven't and are enjoying the content, make sure to hit the thumbs up and the subscribe button. Finally, if you want to support the channel a little bit more, make sure to check out my special offer at fool.com/Jose. Now back to today's episode.
So PC growth is definitely a nice growth opportunity for them. The other nice growth opportunity that they discussed is the data center market. And in the data center market, like I mentioned, we've seen Microsoft release their Cobalt 100. We've seen Google release the Axion CPU that was recently announced. Amazon has the Graviton, and the list goes on and on of all these cloud server providers and big data center players kind of create their own CPU solutions to improve the cost of running these huge data centers. So the CEO believes that this is still a nice growth opportunity for them. And especially now as we're going into the AI space, we're seeing things like NVDA release the Grace Hopper CPU, which they believe can grab a nice amount of market share as well. So the data center is another big opportunity for them. Now, one thing that we're seeing right now with the AI market is also driving this company to probably get more market share in the future. And the reason to think about it is AI, the way to think about licensing is AI right now. Software is moving faster than hardware. So we're seeing all these advancements in software, but sometimes hardware can't keep up. So the hardware designs needs to be upgraded quickly to make sure that they can capture the needs of these new AI workloads. So what's happening right now is all these players, right? We're seeing the AI PC, and this is where Qualcomm came in the PC consumer space, where they are developing ARM-based CPUs that do have some form of AI solution via some of their own IP. And this is kind of allowing new players to come out and say, hey, look, the AI market is big. We want some market in this space. So we're going to create some ARM based CPUs. So I think this is going to continue to happen. And remember, it's not just in the laptop market, right? CPUs and all these kinds of processors can be used in other things like smartwatches, like smartphones, right? We're going into the AI phone space as well, where all these kind of big these big phone players are also creating some form of AI phone solution, tablets, like I mentioned, and any type of Internet of Things as well, like robotics, and any smart home related product as well will be able to use some of these solutions. So the AI market is definitely helping ARM solution continue to grow. Now, another cool growth opportunity for them is CSS. And for those that are not familiar with CSS, this is their compute subsystem solution. So, their compute subsystem solution, what they mention is the fastest path to production silicon with world leading performance on leading edge technology. So, pretty much, let's say you are a chip design company. For you to design a chip from scratch, it could take multiple years. But ARM has already kind of created kind of this system where they can create this amazing solution. And here's their ARM Neoverse CSS. Neoverse, for those that are not familiar, is for like their server solutions. So here they kind of create this super powerful CPU solution. And now you, as the chip design company or the big tech player, you only need to do either something of partner specific on chip accelerators, some power controllers, some input and output modules, some memory solutions, and some partner innovation as well. So it reduces the cost of developing a new chip, and it reduces the time of engineering work that you need to bring that system up to par. So they believe their CSS is a huge market opportunity. Like I mentioned, Microsoft recently released their Cobalt 100, which was their CPU for the data center market, and that was a great version of their CSS. Now CSS is also entering into like the automotive market, as we're seeing kind of the autonomous market solution in forms of if you want to run some form of autonomous robot, you need to train it in some form of data centers. So they're creating these kinds of solutions also for the automotive market. The great thing they mention here is they are oversubscribed on this compute subsystem strategy, and right now they have more demand for the product than anticipated, and they anticipate of growing that significantly over time. So this is a great opportunity for them as well. Now, another thing that we want to learn from their overall earnings was the amount of growth they expect for this upcoming quarter and for the fiscal year. So for quarter one, they expect licensing and other revenues to be up sequentially, driven by revenue from their backlog. But when you look at their fiscal year of 2025, they expect revenue to be up 17 to 27% year over year. So it's definitely a nice amount. But in my opinion, when you look at that revenue growth, when you look at the full non-GAAP earnings per share, which is expected to be $1.45 to $1.65, sometimes you might be left wondering, hey, Jose, why is this company worth at a $60 at a 60 PE ratio when it's only growing around 20%, mid 20%, and when its earnings per share are less than $2 right now? Why is it worth it? And I believe this is the answer right here. So I did not think about this too much. So right now they mentioned that when it comes to the licensing technology, they get that revenue almost right off the bat. And recently, especially with all this AI transformation, with all these data centers transforming into all these data center players creating their own CPUs, they're getting a nice amount of licensing revenue. But it takes about 2 to 3 years on the best case scenarios to start to see royalty, right? Because from production, from design step to production, it takes some times. So right now we're seeing all these big tech companies, all these consumer players, all this new technology that's being transformed and created. All that is being pushed in the licensing tech, in the licensing revenue. But within the next few years, all that is going to transform into the royalty revenue as well, and can really boost this company's earnings per share. So that's why if we take a closer look at this company's PE ratio right now, they look pretty expensive, but that's because, in my opinion, maybe investors are expecting that, hey, look, maybe year one is going to be weak, maybe next year is also not going to be as strong, but in the upcoming years we're going to start to really pick up of that royalty revenue, and these PE ratios are going to contract. So while I don't believe ARM is that complete overvalued monster that it was, I think it still is a bit overvalued. I personally wouldn't want to purchase ARM at these levels right now, but if you are a shareholder, it seems like this stock has at least been priced for at least the next 2 years. And what we really want to see, or what investors are really going to want to see, is what kind of guidance is expected for the next years after that. So this is a stock that's very valued in the short term, but if those royalty revenues does pick up, then that could be a very great positive track for this company. In my opinion, I still would stay away, but like I mentioned, they do have various growth opportunities that investors are going to keep a closer eye on. So take care, have a good day, and see you next time.